So the first thing we need to look at is the 4% rule. How much can you take out of a portfolio? This is a theory within our industry, and safely ensure that your money will last or still even grow over your lifetime. So the rule of thumb has become the 4% rule. You can take, if you have $2 million, you could take 4% or $80,000 a year out of that portfolio, adjust it for inflation every year, and you would never run out of money. So let's look at how that theory holds up. This is a chart graph, and I'm going to explain. It's a little busy. At the bottom, we have the stock allocation, 0 on the left, 100% on the right. And on the side, we have the probability of failure. Statistically, if we're in 60% in stocks and we take out 4% a year, that's that light blue line, we have a 50% chance of success, which means we have a 50% chance of failure. If we actually go to 100% stocks, we still have a 40% chance of failure, depending on when we do it. And so the problem with the 4% rule is it may work in certain portfolios, but it doesn't work in portfolios that are primarily stocks and bonds only. So we have a story to tell. This is a couple's tale. Now, I want you to notice this couple, and this is important because we normally don't try to market our services here when we're talking to people, but you'll notice this couple is very telegenic, and in addition to that, they're in the gifted program. So if you do become a client of our firm, you're guaranteed that both of those things will come true. Bob and Linda are both age 60. They're in good health, and they're thinking about retiring. So here are the other facts that matter. Bob's a lawyer, Linda's a dentist. They're both incorporated. They each have personal savings of about $2 million each in corporation and registered and personal assets. Now, Bob's portfolio is represented by the 60-40 type of Morningstar Balanced Index. Linda's portfolio is invested with us in the core portfolio. And they want to know the likely impact of withdrawing 4% of their capital annually. You know, how will they do? So what we did was we go back and recreate a model for them saying, okay, just imagine you retired in 2000, and we're now looking, it's 19 years later. How does it all look? So, first things first. They both start with $2 million. They both spend $1.8 million of income. That's the $80,000 a year of income being indexed over 19 years. Bob ends up with $1.7 million, so he's getting a little wobbly on his capital. He's down $300,000. But Linda is at $3.7 million. So she has a significant margin of error on her model. So what happened? Well, Bob's index income was greater than his overall return. And 85% of Linda's return came from cash flow being generated by the rents, the dividends, the interest on the portfolio. So she wasn't in a situation where when markets were down, she had to sell anything. So, and when you start stripping money out of a portfolio, when markets decline, just think of last year, when the markets declined, let's say, I think Rob suggested a little under 20%, and you're taking out you're selling the same amount of stocks every month, except, of course, in the month when the market's down 20%, you have to sell at least 20 to 25% more shares to get exactly the same income. So that's the problem. The volatility of the market hurts you when you're spending money from your portfolio. In Bob's case, he had 6 losing years out of 19 with a combined loss of 28%. Linda had 2 losing years with a combined loss of 7. And that's the difference.